Okay, let's unpack this. We all file that main tax return every year, right?
Mm-hmm.
But the sources you've shared, they really show that the tax code isn't just one big highway. It's got these specific, off-ramps and side roads that pop up depending on some surprisingly common life events.
Yeah, like maybe you've got family wealth you're thinking about passing on,
Yeah.
or maybe you hired someone to help around the house.
Or started a business or even, took a job overseas.
That's precisely what makes this material so interesting. It moves beyond just the general rules
Yeah.
and dives into how detailed things get in these specific, often pretty impactful situations.
Right.
Situations that, frankly, a lot of people might stumble into without realizing the tax complexity involved.
Exactly. So our mission today is to take the stack of sources, your articles, research notes, and really do a deep dive into some of these exact scenarios. We're going to try and pull out the most important nuggets, help you understand what's really key about each area.
Sounds good. We'll be looking at things like the alternative minimum tax, sometimes called that parallel tax system.
Mm-hmm.
We'll also look at the kiddie tax rules, which can be pretty confusing.
Yeah.
And then tackle the tax side of hiring household help, the nanny tax.
And we'll definitely spend some time on the qualified business income deduction. That's a huge but expiring opportunity for lots of business owners.
A big one. And finally, we'll wrap up with a look at the complex world of foreign income and taxes.
The goal really is to cut through the jargon, shine a light on why these rules exist, and pull out the critical points from this material that you absolutely need to know about. Let's find those aha moments.
Let's do it.
Absolutely. So let's start with that idea of a parallel tax system, the alternative minimum tax, or AMT. It sounds complicated, but the sources explain it's basically designed to catch folks who might otherwise use certain deductions or credits to, wipe out their regular tax bill almost completely.
Right. It makes sure everyone pays at least some minimum amount. It actually dates back to 1969, trying to address that fairness issue.
And what's really interesting based on this material is how it kind of runs alongside the regular system. You figure out your tax one way,
Under the standard rules.
and then you figure it out again using the AMT rules, which have different adjustments and stuff, and you end up paying whichever is higher.
Exactly. Two separate calculations.
Okay, two calculations. Now, the sources really highlight a massive change that came with the Tax Cuts and Jobs Act, the TCJA. How did that shake up the AMT?
Oh, that was huge.
Oh.
This is where things shifted dramatically for a lot of taxpayers.
Yeah.
The TCJA basically jacked up the AMT exemption amount substantially.
The amount you can earn before AMT even becomes a possibility.
Precisely. And that exemption is now quite high, plus it gets adjusted for inflation every year. So the key takeaway here, according to the material, is if your alternative minimum taxable income, that's your income calculated under AMT rules, falls below this much higher exemption threshold, you just won't owe AMT. Period.
Right.
Doesn't matter about your deductions or anything else below that level. This change literally took millions of taxpayers off the AMT rules.
Okay. So for most people, the AMT isn't really the concern it used to be thanks to those higher numbers. But the sources still list specific things that can still trigger it, right? Even with the higher thresholds. What are the usual suspects?
Yeah, it's less likely now, but definitely still possible. And the material points to several triggers. They're often tied to specific financial moves, not just having a high salary in general.
Yep.
Like having really high itemized deductions could play a role if your income's also high, though the cap on state and local taxes under TCJA reduced that trigger a lot.
Right.
But other key things are exercising incentive stock options.
Yeah.
That's a big one, consistently mentioned.
ISOs, yeah.
Large sales of capital assets, selling property or investments, leading to significant long-term gains. That can push you into AMT territory.
Oh.
And kind of unexpectedly, tax-exempt interest from certain private activity municipal bonds. That interest might be tax-free for regular tax, but it gets added back in for AMT calculations.
Huh. Interesting that it's less about just earning a ton and more about how you earn it or specific investments. So exercising those stock options or buying certain muni bonds could suddenly bring this parallel system back into play.
That's exactly it. It forces you or your tax preparer to run the numbers both ways because those specific items get treated differently under AMT rules.
Yeah.
Individuals figure this potential tax out on Form 6251.
Form 6251. Got it. So for you listening, why keep the AMT on your radar even if you haven't owed it recently?
Well, the relevance really lies in those specific triggers. Even if your regular income isn't sky high, a single big financial event like exercising a bunch of stock options or selling a business or rental property with a large gain could potentially tip you into AMT territory for that year. So being aware of these particular tripwires, like the ones detailed in the sources, just allows for better planning. Avoids that nasty surprise tax bill.
Yeah.
It's about knowing that certain moves have different rule sets attached.
That makes perfect sense. It's the nature of the income or deduction, not just the amount.
Yeah.
Okay, let's switch gears to something that sounds maybe simpler, but has these very specific rules designed to stop, well, tax games. The kiddie tax.
Yeah, this law, as the sources explain it, came about to close a specific loophole. What used to happen is wealthy families would shift income-producing investments, like stocks or bonds, over to their young kids.
Okay.
Since the kids had little or no other income, those investment earnings would get taxed at super low rates, or maybe not at all. The kiddie tax basically says, nope, and taxes that unearned income at the parent's higher tax rate instead.
Ah, so the idea was to level the playing field, stop using kids as tax shelters.
Pretty much.
Yeah.
But the material is really clear about what it applies to. Only a child's unearned income. We're talking typical investment income interest, dividends, capital gains distributions, even unemployment benefits count as unearned. But it absolutely does not apply to earned income.
Like wages from a summer job.
Exactly. Money a child earns from working or even allowance for actual chores, that's not subject to the kiddie tax.
That's a really critical distinction, earned versus unearned. And there are thresholds involved too, right? Based on the 2024 numbers in the material?
Yes, there are. The kiddie tax might kick in if a child's total investment income for the year is more than $2,600 for 2024. It's a pretty low bar.
Okay.
Now, the first slice that, the first $1,300, is actually tax-free for the child. Completely free.
Nice.
The next $1,300 is taxed, but it's taxed at the child's own marginal rate, which is likely very low.
Still good.
It's only the amount of investment income above that $2,600 total. So anything over the first $2,600, it gets hit with the kiddie tax. And that chunk is taxed at the parent's tax rate.
Okay, so it's not all the investment income getting the parent's rate, just the amount over $2,600.
Got it.
Are there situations where a kid might have, say, $3,000 in investment income, but still not be subject to this rule?
The sources list a few specific exceptions. If the child doesn't have any living parents at the end of the year, no kiddie tax. Obviously, if their unearned income doesn't cross those thresholds, it's a non-issue.
Sure.
And here's an interesting one. If the child is married and files a joint tax return with their spouse, they are not subject to the kiddie tax. Doesn't matter how old they are, if they're a student under 24, the joint return overrides it.
Interesting, that joint return exception. Okay, so how do families actually handle reporting this? Does the kid file their own return? Do the parents put it on theirs?
The material lays out two main ways. The most common approach is for the child to file their own tax return, a Form 1040. They then have to attach Form 8615, which is specifically used to calculate the kiddie tax using the parent's tax rate information.
Okay, Form 8615 on the child's return. What's the alternative?
The alternative is that the parents can choose to report the child's unearned income directly on their own Form 1040. They use a different form for this, Form 8814.
That sounds potentially easier. Is there a catch or a reason you couldn't use that simpler Form 8814?
There is, and it's a crucial one the sources point out. To use Form 8814 on the parent's return, the child's income can only be from interest, dividends, or capital gain distributions. That's it.
Ah.
If the child has any other kind of income, especially any earned income from a job, even a little bit alongside their investment income, the parents cannot use Form 8814. In that case, the child must file their own return and use Form 8615.
That is a really important detail for parents thinking about that simpler option. Okay, quick question. What about the net investment income tax, the NIT? Could that 3.8% tax apply to a child's investment income too?
The sources touch on this, but they frame it as, well, pretty unlikely. Technically, yes, a child's investment income could be subject to the NIT, which hits higher earners. But the income threshold to even trigger the NIT is quite high, over $200,000 for single filers. The material basically says a dependent child having over $200,000 in taxable income, high enough to trigger NIT, is an extremely rare situation.
Yeah, you'd certainly hope so. Okay, so bringing this back to the listener, why should parents or maybe grandparents care about these specific kiddie tax rules?
Well, if you're a parent or grandparent or anyone thinking about gifting investments to a child, you absolutely need to understand these rules. It totally changes the tax picture on that gift.
How so?
What might seem like a smart way to use a child's low tax bracket can actually backfire. If that investment income goes over the $2,600 threshold, boom, it starts getting taxed at your higher rate. Being aware avoids nasty surprises and helps you decide the best way to structure financial gifts or support for kids.
Definitely sounds like something requiring a closer look than just giving money. Okay, let's shift gears completely. A situation lots of households encounter, hiring help. Let's talk about the tax rules for household employees, often just called the nanny tax.
Yes, and the key idea here, based on the source material, really boils down to control. Who controls the work?
Meaning?
Meaning, a worker is generally considered your household employee if you have the right to control what work they do and, importantly, how they do it.
Ah, the how.
Right. And this applies whether they're full-time, part-time, paid hourly, daily, weekly, doesn't matter. Even if you found them through an agency. If you're the one directing their work in your home, they're likely your employee for tax purposes.
So if you're telling someone, clean the kitchen this way, or be here at 8, take the kids to the park, then do crafts, that points towards employee.
Exactly. The sources give the usual examples. Babysitters, nannies, housekeepers, private nurses, folks who do regular yard work under your direction, even a private chauffeur.
And who would not be a household employee then?
Well, the contrast is someone who's genuinely self-employed. Think of a cleaning service that sends different people, uses their own supplies, sets their own hours, and works for many clients. Or a daycare provider who watches several kids in their own home, they're running their own business.
Right, control is the big differentiator. Okay, so if someone is my household employee, is there a certain amount I have to pay them before tax stuff kicks in?
Yes, there's a specific wage threshold. For 2024, if you pay a household employee cash wages, and cash includes checks, money orders, etc., of $2,700 or more in the entire calendar year.
$2,700 for the whole year. That seems low. It could easily apply to someone working just a few hours a week.
It really can. And if you hit that threshold, then you, the employer, have specific tax responsibilities that go way beyond just handing over cash.
Okay, what are those responsibilities?
This is where it gets more formal. First, you generally have to withhold the employee's share of Social Security and Medicare taxes, that's FICA tax, from their wages. And critically, you also have to pay the employer's matching share of those taxes.
So both halves?
Both halves. The total FICA tax rate is 15.3% of the wages, half from the employee, half from you. You report and pay these employment taxes using Schedule H, household employment taxes.
Schedule H, okay.
And you file Schedule H along with your own personal Form 1040 tax return. But wait, there's more. To even file Schedule H, you first need to get an employer identification number, an EIN, from the IRS.
Wow, an EIN, just like a regular business. That really does make it sound official.
It is official. And on top of that, you're also required to prepare a Form W-2, the wage and tax statement, for your household employee at the end of the year and give them a copy, just like any other employer would.
Okay, FICA taxes, Schedule H, EIN, W-2. What about federal income tax? Do I have to withhold that too?
Good question. The sources clarify that, interestingly, you are not required by law to withhold federal income tax from a household employee's wages.
Oh.
However, you can choose to withhold it if the employee asks you to, and you both agree on it by filling out a Form W-4. But even if you don't withhold income tax, and even if the wages are below that $2,700 FICA threshold, remember, the wages are still taxable income to the employee. They still need to report it.
Right. Okay, FICA is the main employer headache here, separate from the employee's income tax liability. Are there any exceptions to paying those FICA taxes, even if I pay someone over $2,700?
Yes, there's a notable family exception mentioned. Wages you paid to your spouse, your parent, or your own child who is under age 21 are generally exempt from these Social Security and Medicare tax requirements.
Ah, okay, that makes sense for keeping it in the family. So wrapping this section up for the listener, what's the big takeaway?
I'd say if you regularly pay someone for services performed in your home, could be childcare, cleaning, cooking, gardening, whatever, and you're the one directing how they do the work, you need to be really mindful of that $2,700 annual wage threshold. Hitting that relatively low amount makes you a household employer and triggers these requirements. Paying and reporting FICA taxes via Schedule H, getting an EIN, issuing a W-2. It's easy to overlook, especially for part-time help, but ignoring it can lead to back taxes and penalties. Important to get it right.
Definitely a common situation with some specific hoops to jump through. Okay, let's pivot now to something really crucial for business owners. The Section 199A Qualified Business Income Deduction, usually just called the QBI deduction.
Yes, this is a really significant provision that came out of the TCJA legislation. And the sources highlight that it lets owners of most pass-through businesses get a potentially hefty deduction,
Pass-through businesses meaning.
like sole proprietorships, Schedule C filers, partnerships, S corporations, even some trusts and estates. For these folks, it allows a deduction of up to 20% of their qualified business income.
Up to 20%. Wow, that's a substantial chunk off your taxable income. What kind of taxes does it actually reduce?
That's a key point the material makes clear. It's purely an income tax deduction. It lowers your taxable income for income tax purposes, but it does not reduce other things like self-employment taxes or excise taxes or penalties, just income tax.
And do you have to itemize your deductions on Schedule A to get it?
Nope. That's one of its big advantages. You can claim the QBI deduction whether you itemize or just take the standard deduction. The sources also note it's available even to non-resident aliens if they have qualifying U.S. business income.
So it's pretty broadly available, but the sources also wave a big red flag about its future, don't they?
They absolutely do, and this is critical for planning right now. The QBI deduction is currently scheduled to just disappear.
Yeah.
It expires after 2025 unless Congress specifically acts to extend it.
Okay, so a major benefit that's on the clock. Business owners need to pay attention. How is this deduction actually calculated? The sources seem to break it down into a couple of pieces.
Yeah, at its core, there are two main components that can add up to your total deduction. The main one is the QBI component. That's potentially 20% of your qualified business income from a domestic trade or business you operate.
Okay.
The second part is the REIT PTP component. That's 20% of any qualified dividends you receive from real estate investment trusts, or REITs, and 20% of qualified income from publicly traded partnerships, or PTPs.
And how does this actually get claimed? The business itself doesn't take the deduction, right?
Correct. The business entity, the S Corp, or partnership, does the work of figuring out the qualified income, the relevant W-2 wages, the property basis, all that stuff. They report that information to the owners.
Usually on a Schedule K-1.
Exactly, on Schedule K-1. Then the individual owner takes that information and actually claims the deduction on their personal tax return, their Form 1040 or 1040-NR. They'll use a separate form, Form 8995 for simpler cases, or the more detailed Form 8995A to calculate the deduction amount. Then that final number flows onto their main tax return.
Okay, so the business provides the raw data, the owner computes and takes the deduction. What kind of income does not count as qualified business income? What gets excluded?
The material lists several important exclusions. Your wages as an employee, generally not QBI. Investment-type income, like capital gains, interest, dividends, usually excluded unless maybe it's directly earned by the business itself and its operations.
What else?
Hobby income is out. Non-taxable income doesn't count. Guaranteed payments partners receive for services, not QBI. And the big one, income from just passively holding rental property usually doesn't qualify either, unless that rental activity rises to the level of being an actual trade or business.
That rental income piece sounds tricky. Is there a clearer way for rentals to qualify?
Yes, thankfully. The sources highlight an IRS notice, 2019-07, which created an optional safe harbor test specifically for rental real estate activities to be treated as a trade or business just for QBI purposes.
A safe harbor. So like if you meet these specific rules, you're definitely considered a business for the deduction.
Exactly. It provides a clear path, but it has requirements.
What are the main ones?
You need to show a certain level of activity. The big one is performing at least 250 hours of rental services per year for that rental enterprise.
250 hours. By whom?
It can be you as the owner, your employees, independent contractors you hire, other agents working for the rental. Their time can count towards the 250 hours. And you generally need to meet this hour requirement in at least 3 out of the last 5 consecutive tax years. Other crucial parts. You have to maintain separate books and records just for the rental enterprise. And you need to keep really good contemporaneous records logs showing the hours, describing the services, the dates, who performed them.
Wow, sounds like serious record keeping.
It is. And if you use this safe harbor, you absolutely must attach a signed statement to your tax return saying you're using it and meet the requirements.
Okay. Are there any types of rentals that just can't use this safe harbor even if they meet the hours?
Yes, a couple of key exclusions. Triple net leases, where the tenant handles most costs and upkeep, are generally out. And also, any property where you, the owner, use it as a personal residence for part of the year under the vacation home rules, they can't use the safe harbor either.
Okay, so rental property owners wanting QBI need to be super diligent about tracking hours and records if they want that safe harbor protection. Now let's get into the weeds a bit. The sources really emphasize some major limitations on this QBI deduction, especially once your taxable income gets higher.
Right, this is where it gets, well, significantly more complex, as you said. Once a taxpayer's overall taxable income crosses certain thresholds, and these thresholds are indexed for inflation. For 2024, they start phasing in around $384,000 for married couples,
Yeah.
about half that for others.
Yeah.
Above those levels, the potential 20% QBI deduction can get limited or even wiped out, depending on two main factors:
There.
the type of business it is and the amount of W-2 wages the business pays, or the amount of qualified property it owns.
Okay, let's tackle the type of business limitation first.
Yeah.
The sources talk about a specified service trade or business or SSTB. What's that about?
Right. An SSTB is generally defined as a business where the main asset is the skill or reputation of its owners or employees. Think fields like health, law, accounting, consulting, financial services, performing arts, athletics.
Services, basically.
Mostly, yeah.
Yeah.
And the key insight from the sources here is, if your personal taxable income is above the top of that phase-in range and your business is an SSTB,
Then what?
then the QBI deduction for the income from that SSTB business is generally disallowed, completely phased out.
Ouch. So if you're a highly paid doctor or lawyer running your own practice and your total income is high, you might get zero QBI deduction from that practice income.
That's often the case, yes. However, there's an important carve-out mentioned. The fields of engineering and architecture are specifically excluded from the definition of an SSTB for this rule, so they can still potentially get the deduction even at high income levels, subject to the other limitation.
Okay, good news for engineers and architects. Are there any minor exceptions, like if only a tiny part of your business is an SSTB?
Yes, there are de minimis rules. If a business has overall gross receipts under a certain threshold, around $25 million, it's not treated as an SSTB if less than 10% of its receipts come from those specified service activities. If receipts are over $25 million, the threshold drops less than 5% has to come from SSTB activities.
So maybe a manufacturing company with a tiny consulting division might still be okay if the consulting part is small enough?
Got it. Now, what about businesses that are not SSTBs, like that manufacturer or a retailer or a construction company? Do they face limitations if the owner's income is high?
Yes, they do. That's the second major limitation, the wage and property limitation. If your taxable income is above that phase-in threshold range and your business is not an SSTB or it meets the de minimis rule, your potential 20% QBI deduction gets capped.
Capped how?
It's limited to the greater of two amounts. Either 50% of the qualified W-2 wages paid by that specific business, or are 25% of those W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition, they call it UBIA, of qualified property used in the business. Okay, whoa, that's a mouthful. 50% of wages, or are 25% of wages plus 2.5% of property basis. But the basic idea seems to be, if your income is high, you need either employees on payroll or significant business assets to get the full deduction.
That's the crux of it. Exactly. You need one or the other, or a combination. The sources define qualified W-2 wages pretty specifically. It's the actual taxable wages reported on W-2s paid to employees, not payments to independent contractors, plus things like employer retirement plan contributions.
And the property basis, the UBIA.
UBIA basically means the original cost when you first acquired certain tangible, depreciable property used in the business. Think buildings, machinery, equipment, furniture. It has to be property that still has a depreciable life left or was placed in service within the last 10 years. Importantly, land doesn't count, and neither do intangible assets like patents or goodwill. It's about the physical stuff.
Okay, original cost of physical assets. So what's the big picture impact here? If you're a high-income owner of a non-SSTB, what does this limitation mean practically?
The key insight from the material is this. If your personal taxable income is up in or above that phase-out range, your business generally needs to have either significant W-2 payroll or substantial qualified depreciable property, or both, to allow you to claim the full 20% QBI deduction.
And if it doesn't?
If you have a business that generates high income but maybe has very low payroll, perhaps you use mostly contractors or minimal depreciable assets, your QBI deduction could be significantly slashed, maybe even down to zero by this limitation, even though you have plenty of qualified business income.
That's a critical planning point. Okay, connecting this back to the listener, especially those running their own businesses.
Look, this deduction, potentially worth 20% off your qualified income, is incredibly valuable.
Right.
But remember, it's set to expire after 2025. So understanding these really complex rules now is essential. especially whether your business might be considered an SSTB, how those de minimis rules might apply, and crucially, how the wage and property limitations could impact your deduction based on your income level and your business's structure, its payroll, its assets. Getting a handle on this is key for tax planning today to maximize this benefit while it's still around. And for real estate folks, that rental safe harbor is super important too.
Absolutely, something business owners need to be digging into right now. All right, let's move to our final deep dive area, foreign income and taxes. This affects anyone with financial ties outside the U.S., right?
It really does. And the fundamental starting point here, laid out very clearly in the sources, is the U.S. system of worldwide taxation. If you are a U.S. citizen or a resident alien,
Green card holder, for instance.
right, or meet residency tests, you are taxed by the United States on all your income, period. Doesn't matter where in the world you earned it or where you happen to be living when you earn it.
Worldwide income is potentially subject to U.S. tax.
Okay.
So how does income you earn from actually working in a foreign country fit into that?
That's where the concept of foreign earned income, or FEI, comes in. The sources define this specifically as income you get for personal services you perform while your tax home is also in a foreign country.
Tax home, meaning your main place of business or work?
Generally, yes. So think wages, salaries, professional fees, self-employment income earned while you're living and working abroad. But crucially, the material points out this does not include things like investment income, interest, dividends, passive rental income, pensions, or retirement distributions earned abroad. That stuff is treated differently.
Okay, so FEI is specifically about active work income earned overseas, and there's a way to shield some of that from U.S. tax, correct? The Foreign Earned Income Exclusion, or FEI.
Yes, the FEI is a major benefit for U.S. expats. It allows you to exclude a pretty significant amount of that foreign earned income from your U.S. taxable income. For 2024, the maximum exclusion amount is $126,500 per qualifying person.
Per person. So if a married couple is living and working abroad,
Exactly. The sources confirm it's per person. If you're married and both spouses live and work abroad and both independently qualify for the exclusion, each of you can claim the FEIE on your respective foreign earned income. So potentially, they could exclude a combined total of $253,000 in 2024.
wow. But just like the income itself, this exclusion only applies to the earned income part, right? Not foreign dividends or interest.
Correct. You can't use the FEIE to exclude passive investment income earned abroad, only the income from your work.
Is claiming this FEIE automatic if you qualify?
No, absolutely not. This requires you to take action. You must file a U.S. income tax return, even if all your income is excluded, and you must attach Form 2555, Foreign Earned Income, every single year you want to claim the exclusion.
Every year, file Form 2555.
Every year you want the benefit. Once you make the election to use the exclusion, it generally stays in effect for future years unless you formally revoke it. But you still need to file the form annually if you have qualifying income you want to exclude.
Okay, file the form annually. What does it take to actually qualify for the FEIE in the first place, beyond having foreign earned income and a foreign tax home?
You need to meet one of two tests described in the sources. First is the bona fide residence test. This generally means you have to be a legitimate resident of a foreign country or countries for an uninterrupted period that includes one entire tax year. Think establishing deeper roots abroad.
Okay, bona fide residence. What's the second test?
The second is the physical presence test. This one is purely about counting days. You have to be physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months.
330 days in any 12-month stretch.
Right. And the material notes that this 12-month period doesn't have to be the calendar year. It can start and end mid-year, which sometimes means you have to prorate the maximum exclusion amount for the tax years involved.
Okay, those tests seem pretty clear about needing to be genuinely based overseas. Is there anything else related to living abroad, like housing costs, that you can get a tax break on?
Yes. The sources also discuss the foreign housing exclusion or deduction. This is in addition to the FEIE. If your housing costs in the foreign country exceed a certain base amount, you might be able to exclude, if your employer pays for housing, or deduct, if you pay for it yourself, typically with self-employment earnings, a portion of those qualified foreign housing costs.
Like rent, utilities?
Yeah, reasonable costs for your housing rent, utilities, repairs, maybe furniture rental. Not lavish or extravagant expenses, though. And this benefit only applies for the part of the year you actually qualified for the FEIE. Also, while it reduces your income tax, the sources note it does not reduce your self-employment tax if you're self-employed abroad.
Okay, so some help with housing on top of the earned income exclusion. Now, what about the taxes you actually pay to the foreign government on all this income? You mentioned worldwide taxation by the U.S. Sounds like double tax potential.
Huge potential, yes. And this is where the system tries to provide relief, as the sources explain. For the foreign income taxes you pay, you generally get a choice.
A choice.
Yes. You can either take those foreign income taxes as an itemized deduction on Schedule A of your U.S. return, just like you might deduct state income taxes, or you can claim a foreign tax credit, FTC, against your U.S. income tax liability. You generally calculate the credit on Form 1116.
And you can just pick whichever one saves you more money, deduction or credit.
Exactly. The credit is usually more valuable because it reduces your U.S. tax dollar for dollar, whereas a deduction only reduces your taxable income. But you can choose whichever gives you the better result each year. And you can even switch back and forth between claiming the deduction one year and the credit the next.
That's flexible.
And what's really interesting here, the sources point this out, is the time frame for changing your mind after you filed. If you took the deduction but later realized the credit would have been better,
Yeah.
you can file an amended return to switch from the deduction to the credit for foreign taxes paid in that prior year anytime within 10 years from the original due date of that return.
10 years? That's a really long time compared to the usual 3-year amendment window.
It's exceptionally long, yes. Gives you a lot of time to reconsider.
Okay, let's focus on that foreign tax credit, the FTC. Who qualifies for it?
U.S. citizens and resident aliens are generally eligible. The sources lay out 4 basic tests the foreign tax itself has to meet to qualify for the credit.
What are they?
1. The tax must be imposed on you, the taxpayer. 2. You must have actually paid or accrued the tax. 3. It has to be a legal and actual tax liability. You can't volunteer to pay extra. And 4, critically, it must be an income tax in the usual U.S. sense, or a tax paid in lieu of an income tax. It can't be something like a foreign sales tax, property tax, VAT, or excise tax.
So it has to be an income-based tax. Does the FTC apply only to taxes paid on foreign earned income like the FEIE, or is it broader?
This is a key difference, and the FTC is much broader here. Unlike the FEIE, which is strictly for earned income, the sources confirm the FTC can be claimed for qualifying foreign income taxes paid on any type of foreign source income.
Including investment income.
Absolutely. Foreign taxes paid on foreign dividends, interest, royalties, capital gains, those can all potentially qualify for the FTC. However, there's a big limitation. You absolutely cannot claim the FTC for foreign taxes paid on income that you have already excluded from U.S. tax using the FEIE or the foreign housing exclusion.
Ah, right. No double dipping. You can't exclude the income and take a credit for the tax on that same excluded income.
Precisely. You have to choose one benefit or the other for that specific income.
How do people typically find out about foreign taxes paid, especially on investments?
Well, if you have foreign investments held through U.S. brokers, you might see the foreign tax paid reported directly on the information forms you receive, like Form 1099 INT for interest or Form 1099 DIV for dividends.
Okay.
The sources also mention a potential shortcut for claiming the credit if the amount is small. If your total creditable foreign tax for the year is pretty low, the threshold is $300 for single filers, $600 for married filing jointly, and all your foreign income is passive income, like interest and dividends, reported to you on a qualified pay statement like a 1099.
Yeah.
You might be able to claim the credit directly on your Form 1040 without needing to file the full, often complex, Form 1116. But if your taxes are above those small amounts, or your income isn't that specific type of passive income, then Form 1116 is required.
Good to know about that potential simplification. Are there any specific foreign taxes that definitely don't qualify for the FTC, even if they seem like income taxes?
Yes, the sources list a few no-goes. Things like interest or penalties you had to pay to a foreign country don't count. Taxes paid to countries designated as supporting international terrorism are excluded. And there are special complex rules limiting credits for taxes on foreign oil and gas extraction income.
Okay, lots of detail there. This is all incredibly helpful for anyone working or investing internationally. So pulling it together for the listener, what's the main takeaway on foreign income and taxes?
I think the biggest thing is, if you're a U.S. person earning money or holding investments outside the U.S., you absolutely need to understand these rules. The U.S. taxes your worldwide income, but tools like the foreign earned income exclusion for work income and the foreign tax credit for foreign income taxes paid are your primary mechanisms to avoid crushing double taxation. Knowing when you qualify for the exclusion, when you qualify for the credit, and how to choose the approach that benefits you most, usually the credit, but not always requires careful attention. It's key to managing your U.S. tax obligations effectively when you have international financial activities.
Wow, what a journey through some really fascinating and, yeah, sometimes pretty complex corners of the tax code.
Definitely.
We've really seen how specific life events or financial situations, like exercising stock options with AMT implications, managing a child's investments under the kiddie tax, hiring help at home, triggering nanny tax rules, running a business hoping for the QBI deduction, or earning income internationally each come with their own detailed set of rules, exceptions, and reporting needs. All stuff laid out in the material you brought.
It really does underscore that the tax system isn't just one big blunt instrument, is it? It has these highly targeted provisions, often designed to address very specific activities, or like you said, prevent certain outcomes, like that original income-shifting loophole the kiddie tax aimed to close.
Exactly. And, that brings us to maybe a final thought to leave people with. These specific examples we've really dug into today, they vividly illustrate just how granular and, frankly, intricate the tax code can become. It really highlights that just looking at your W-2 or your bank interest or your basic Form 1040 info, well, that's often just scratching the surface, isn't it?
Absolutely. It makes it so clear how important it is to consider your own unique financial picture, your specific activities, and maybe look beyond the most common forms. You need to investigate these less common, but potentially very impactful tax areas. And not just to make sure you're, checking all the boxes and meeting your obligations, but also, critically, to make sure you're actually taking advantage of every exclusion, deduction, or credit that might be available to you, like the ones detailed in sources like these. You don't want to leave money on the table.
A deep dive indeed. Thanks so much for walking us through these specific tax landscapes today.
My pleasure. Always interesting stuff.